All right, guys, this is Weston Means, Bay Area Realtor, here for episode 2 with Mr. Ivan Fung. He's a financial advisor, and today we're going to talk to him about what it's like trying to plan to buy a home in the Bay Area. Created a couple different scenarios. One of them is going to be a single person with kind of like a median income, and then another one is going to be a couple with a little bit lower of an income. Should we go right into the scenarios, or you got anything to
Sure. No,
to
I
say?
say so. As a financial advisor, my job is to manage people's financial, and one of the things I like to do is to help people to get the home they dream of.
Yeah.
So yeah, let's start with the scenario.
Cool. So the first one I thought of is just a single person who makes 100,000 a year.
Okay.
I think the median in the Bay Area is something like 122 or something, right? But anyway, so that's actually slightly lower than the median income. We'll go with 100,000. Single
Sure.
person, let's say they currently they're renting an apartment, 5,000 in an Acorns account, which is a robo
Investment account.
advisor.
Okay.
So it's probably diversified by their risk tolerance.
Any other liquid assets like cash or anything like that?
Let's say they have like 15,000 in the bank. This is just a totally made up scenario. Hopefully we can get some folks that will be willing to share their situations so we can actually go into them in another episode. I'm going to get an attachment for this computer too, so I'll be able to hook up the HDMI and we can actually show the scenarios on the screen. But for today, let's just go into this. It's 100,000. Rental payment is 2,000. They have 15,000 in the bank, and then they have 5,000 in some kind of investment account.
Sure. So first we're gonna look at this. Okay, we have 5,000 in investment and 15,000 in cash. Those are called liquid asset, means that they can convert into cash overnight. So I'll put them in the same category. In this case, clients have about 20,000 in down payment. Now, on a conventional loan, 20,000 that translated to, if that was a 20% down, that's 100. The clients could technically only afford up to about 100K on the houses, unless they get other kind of loans. Like there's some other programs out there, right? They might able to get lower down payment.
Yeah.
But I'm gonna use, but right now I'm gonna say that like this person is able to qualify. The person is gonna use that 20,000. That's their down payment for now. Now I'm going to switch it over to the income side.
Okay.
Okay. And also, when I'm pointing this out, I want everyone to use this that's how their thinking process in terms of like mortgage, because that's how usually, generally speaking, how conventional loans work. So with 100,000, usually what they'll figure out is that what they'll think is that you use 1/3 of your income, your rents for your mortgage. Now,
That's the conventional way of thinking, right?
yes, there are some scenario. Okay, like if you were to use more than 1/3, you might have to pay a little bit higher interest. But I'm just speaking generally speaking. Now, the reason why on the conventional loans we use 1/3 is that 1/3 you use it for your mortgage or your rent. 1/3 should be going to Uncle Sam, taxes, and then 1/3 it should be your other living expenses, like buying groceries, healthcare products for yourself, things like that.
Yeah.
So 1/3, so that will translate into 33,000. Okay, we'll take 33,000 divided by 12, so that translates to 50. Now, this I have not, generally speaking, in the eyes of the banks or the government, they will see that as you will use this amount to pay your mortgage every month. Now, that 2,750, you also need to include property tax and your insurance in here as well. Let's exclude those for now, okay? We'll calculate a little bit backward from that. 2,750.
What is 2,700?
So we'll take
2,750?
100K, 100,000. That's how much the clients make. We'll take 1/3 of that.
Yeah.
And then we also take divided by 12.
Okay, so this is a third of their income divided by
Yes.
12. So
By the whole year.
2,750 a month
Yep.
adds up to 33,000 a year.
Yes. So then right here, now I'm going to take my loan amortization calculator.
Okay.
Let me see.
And I can look up the average 30-year fixed rate right now. So it is about 7.38% for a 30-year fix right now.
Last time I checked it,
Yeah.
on the conventional loan, it's about 6.75.
Oh, that's for FHA?
On the average loan here in the Bay Area at this moment.
Okay.
On the average.
Gotcha.
Does it seem right to you?
I think it depends on the type of mortgage product you get, and it depends on what your down payment is. I think you'll get the best rate if you go with 20% down or more.
Okay. But let's just say we were doing the general conventional loan. So let's say 20% down.
Yeah.
We are doing that 20% down. I'm gonna go with 6.75% at this moment. Okay.
Okay.
Just to make things easier.
Cool.
Now, if there's rate changes, we can adjust this number a little bit. But at this moment, moment, we're
We'll
gonna
go
do
with
we're gonna go
6.75.
6.75. At this moment, with 6.75 interest, if you were to borrow 100K, every 100K with a 6.75, you're looking at your monthly payment about $648.60.
Okay, so about 650
About
for
650,
every
yeah.
100K.
Yeah. So we're gonna take this. We're gonna take that. So since on
Is that principal interest?
principal plus interest for 30 years.
Got it.
So every 100K you with the interest of 6.75, and you borrow every 100K, you are paying $648.60 for the next 30 years of your life. Also get this. Reason why it's called a mortgage is because mortgage means that so you're engaging to death. Okay. So a little bit of history lesson right there. Okay.
That's kind of morbid, but thank
Yeah.
you for that.
So you take that you know from that scenario where your client is making
And
about
this is
100K,
not including taxes and insurance, right?
not including taxes, not including
Okay.
insurance, and not including any other miscellaneous, not even including HOA. So if you have that, then you also have to put that part of the cost. But right now we're gonna go with this wonderful, beautiful scenario, okay, where just straight up finance, okay, just the mortgage itself. So with 2,750, we're gonna divide it by 648. You should so when it comes down to the clients are able to borrow about 400, roughly about
24,000.
yeah, about 424K from here,
Okay.
roughly.
All right.
So given these numbers that we have, so if the clients wanted to take a loan, he's able to borrow 424. Also, given that the client also considered that like, hey, I only have 20,000 as down payment, so they're gonna usually a lot of banks gonna look for the little bit risky on the riskier side.
Yeah, because that's
Yeah.
considered a pretty low down payment.
So that's something that you want to also talk to your mortgage advisor or financial advisor. What is the best way to finance this?
Right.
Okay?
So with these numbers, I would say they can borrow 424,000. They have 20,000 for a down payment. So ultimately they can afford up to about 444,000. And 20,000 divided by 444,000 is 4.5%. So this would be probably like an FHA loan, I'm guessing, if they were to pull the trigger at this moment in time. But us as real estate financial advisors, we'd probably recommend that this client maybe save up for a little more. What do you think you would advise in this situation?
Well, they really depend. Maybe like the client could get a little condo, or maybe the clients can also partner with someone to purchase the properties. But he knows his borrowing power is 424. His down payment, he will have 20,000 as a down payment.
Right.
Now, I'm gonna do this Westons because like a lot of people will. I don't want to give people like skip second guess how this being calculated. Let's just do a scenario with the same number right here. What if there is taxes and also HOA and insurance involved? Let's just do that, okay? So with the same scenario of 2,750, let's just say I'm gonna put this in the wonderful fantasy world that we also have our insurance 1,200. Okay, you have an HOA another 1,200 a year. I know it's not that gonna be that low, but I'm just doing it for the sake of as an educational purpose.
Okay.
So we got the insurance, HOA, and also taxes, okay? Another 1,200. Let's divide it, you add them together and you divide it by 12. You get $300 right now.
Yeah.
So what we'll do is that we'll take that 2,750 minus $300 per month. So you get 2,050. From here now on, we're gonna take that 2,050 divided by 648, 60. That means now the buying power is a lot lower now, meaning the client could borrow $316,000.
So once you add in real estate, we call it PITI. So principal, interest, taxes, and insurance. PITI, that's how we remember it. So initially when he was doing the first calculations.
Oh, sorry, I did this wrong, okay? So we're gonna take that as client have 2,750. We're gonna minus 300 per month now. Taxes, insurance, and also possible HOA. The client has the ability to pay $2,450 a month. Now, with that, we're gonna take that and divide it by 648.60. That will equals to $377,736. That's how much
The amount of loan they can get, right?
That's the amount of loan he or she can get. So you see how, but still, before with interest, taxes, and HOA, this person is able to get a loan of $424,000 now because with those criteria, it lowered to $736.
Once we add the taxes and insurance.
You mean like before? Before just the loan itself.
Yeah.
Now we're adding the taxes, insurance, and HOA. Possible of HOA.
Yeah, so once we've added the taxes and insurance, their buying power went down, or their borrowing
Borrowing
power
power, yeah.
went down from 424,000 to now 377,000.
736.
736. Okay. So it went down quite a bit. It went down like almost 50K. And that's just by adding taxes and insurance and possibly HOA. If you're at that price point, you're almost definitely going to get a condo, most likely. So it just goes to show you when you're doing these calculations on your own and you're looking at, hey, my principal and interest, maybe you go online and you find a mortgage calculator. A lot of these mortgage calculators are only going to give you the principal and insurance portions of that payment, and they're not really accounting for the taxes and insurance. And, you know, as we just demonstrated, if you add the taxes and insurance onto there, the borrowing power comes down substantially. In this case, it came down 50K. So now we're working with a max budget of like about what, 390 or something?
For the borrowing power, yeah, 397, almost 400.
Okay, so I'm actually on the MLS right now. I see a studio apartment in Emeryville. This is a 0-bed, 1-bath, 432 square foot. Very, very small, but maybe suitable for a single person who likes to be outside a lot of the time. And maybe their office is in San Francisco or something, so they don't really care about being at home all the time. It's just really a place for them to go to sleep. So this place is pretty nice. It's by the water. It's the peninsula of Emeryville. This place has a $575 a month HOA fee. And that's actually fairly typical of a lot of places in the East Bay. I mean, this is kind of like right in the middle range. I've seen HOA fees like at 800 or above. The lowest I've seen in the Bay Area maybe around 425. So this is right in that middle range. So if we account for that, what does that do
You
to
know what? How about this?
our
Let's use this scenario because, like, since we have a real house scenario right here,
Yeah.
we have this as a HOA. Is there a way I can get what is the estimate property tax on that?
All right, so in Emeryville, it's $15 per every 1,000 of the property sales price. So that would be, this is listed at 340K. So that would be 340 times 15, 5,100 a year.
Okay. What is the estimate insurance you think gonna cost? Can we say like 1,500 just to you seem?
I think that's a bit of an overestimate, but yeah, let's go with that.
Or you want to go with 1,200?
I like 12,
Okay.
1,200 sounds pretty good for this.
Okay.
Actually, wait, this might actually have the insurance covered under the HOA.
See, that's something to think about too when you're paying for HOA. You want to see what kind of insurance do they cover.
What kind of insurance do you actually need? Because a lot of these HOAs actually have insurance that's already provided for the facility, for the building. Maybe they don't insure the inside of your unit. So a lot of condo owners can get insurance for the inside of their unit. But a lot of times, and in this case, it says, yeah, insurance of the structure, exterior maintenance, which would include the foundation and the roof, is covered by the HOA.
So we don't have to worry about insurance then.
So in that case, yeah.
Okay.
The owner can get separate insurance policy for the inside of their unit, their belongings. You know, if the structure falls over, the HOA will have to pay to rebuild that.
Sure. Now we have some number to work with. Let's go like this. Property tax, 5,100 plus 6,900. On the annual base, you're paying about 12,000 per year. So going back, when this scenario, this person is able to, the income he could use, 2,750, we're gonna minus 1,000 off of that. From here on, we're gonna take that divided by 648.60.
But these days, can't you go up to like 50% of your gross income for a mortgage debt payment?
Yes, really depending on financial institute you're borrowing from. Also, the interest rate. So if you're gonna go over a certain threshold, you consider it as higher risk, and they might charge you extra for the rate. And some places might not even do that kind of loan. So it really depends. If that's the case, everything changes it.
And that's called PMI, right? Private mortgage insurance.
Not PMI yet, but the risk that you're paying, like ability to pay back the bank, basically. So if you, let's just say, if we go with, your debt to income is almost at 50%, but the financial institute may see that as, man, you're in the higher risk. So they want, if it comes to high risk, they want to get their principal back as soon as possible. So, or they had to purchase extra insurance for their own financial institute for these kind of loans.
Yeah.
They might have to charge you a premium for these kind of loans. So rather than the loan is 6.75, they might charge you 7.2. I do know someone that in this market of 6.75, I do know someone pays about almost 9% on their loans.
Damn, pretty high.
And I do know that some of the higher risk loans, they can go up to average about 8 to 10% right now on the higher risk loan. That's something there for you guys to think about when you guys doing certain financials, okay?
Okay.
And also something to bring up to your mortgage advisor or mortgage broker and your financial advisor. Now, I'm going to go back to the scenario. That means right now with all these HOA, the insurance, it comes down to the borrowing ability for this person is become $269,811.
Wow. And that's after we added the HOA fee of $575 a month for this place.
A property tax and HOA $1,000 a month.
Gotcha. Wow. Taxes and HOA.
Yeah.
Luckily, this one doesn't require the insurance, but still pretty high, $1,000 a
But
month.
keep in mind though, like, you know, property tax raise every year and HOA also raise almost every year as well to also consider it. But however, the mortgage, if it's a 30-year fix, it will stay the same for the next 30 years.
Yeah, that's true. But in California, I mean, once you buy your home, it can only increase by, I think, 2% per year maximum for your property. Yeah. The HOA fee can always increase. And taxes increase too.
Yeah.
Once you buy the property, it can only increase by, I think it's 2% per year.
When you're doing your financial, that's something to keep in mind as well.
Yeah, you want to account for any increases over time so that you're not too strapped and you're going to be in a tough situation financially in the future. So this is what financial planning is all about. So we started with the buying power. If there was no HOA fee and no taxes and no insurance, this person would have had borrowing power of 424. They have 20,000 for a down payment, so that's a total of 444. Once we added HOA fee and property taxes for this studio condo in Emeryville, which is 432 square feet, the buying power now went down to
$269,811.
all right, so almost 270. So this place is worth 340, or at least it's listed for 340 on the market. So we're short about 70K now. So in this case, I mean, the only way for this person to buy this place is if they can somehow come up with 70K. Generally, I advise against getting loans and stuff like that because you never know, especially if you're tacking on a payment like this, you don't know how long it's going to take for you to save up for that, depending on your lifestyle choices. What would you recommend?
Well, for this person, right, if you're going to take any other loan, now that become also part of the equation here. You know, the bank is also going to calculate, hey, how the ability for you to pay back other loans as well. So they will take, you know, if you were to borrow 70K, or in this case, you have 20K, you borrow 50K, that will also become part of your debt calculation. So a couple of ways to do it is to see is there any other programs out there that can help that person to either to help subsidize part of it but then pay back later. There's some programs out there, I'm not really familiar with that, something like, you know, first time home buyer kind of program,
Dream for all, yeah,
something like that. But then you might have to ask your if you think that you can't live below your means, you have the ability to pay, you might want to ask your relative if they can also be part of the loan to get that financial to actually get more of a borrowing power.
Yeah,
that could be done too. You might also purchase this property with a partner. You have a significant other. There's ways to do it, but I will also advise you to talk to your financial advisor, mortgage advisor, or your mortgage broker to see any alternative.
okay. So that was kind of a sad scenario.
You know, I think it's really positive still, Weston, because like, you know, this person knows, right? So this person can kind of plan his, now he got the number here, right? So now he can plan, you know, he can see that, hey, maybe, you know, it'll take him 6 months for him to save. It might take him a year, or, you know, he can find other ways to borrow this money without touching his credit. Very doable. And
yeah,
so at least that person knows, okay?
Yeah, I agree. That's why we're doing this podcast. In that scenario, that person was about 70K away. If they can save up 70,000 more over the next couple years, they would be able to afford that place. Now, the only problem with that is home prices tend to go up a little bit over time. Condos don't really appreciate as fast. This same condo, if it doesn't sell right now, or if another one comes on the market that's similar to it, it might go somewhat around the same price, but it might be a little bit higher, maybe like 15, 20,000.
Yeah, I mean, miracle does happen, okay? So for instance, I do have a clients that thought like, oh shoot, I'm not, you know, it was gonna take them like another 3 to 5 years to save up, right?
Yeah.
But then their stock portfolio shoot up. Now, you know, he's able to put more down payment. I did have other clients that, you know, their company offered them stock option, and their stock, you know, just 1 year, it was up by more than 100%, like more than double, triple. That gave him, you know, he sold part of his portfolio or borrowed against part of his portfolio to come up with that money. You know, my point is that at least you know the number, and then, you know, when there's financial changes, you know your leverage, you know your borrowing power. Give us something more. You know, a miracle happens. Like, oh, forget this condo. I want to buy like a premium condo. Instead of 340, you might end up going 780, or rather than a condo, I'm going to buy a single family home or a townhouse. So, you know, at least you know your financial. You could plan accordingly.
Got you. All right, cool. Well, should we go to the second scenario?
Sure. Let's go.
Okay. So this is
You know what? I love doing this, man. I love
yeah.
doing this all day long, you know?
Yeah, this is fun, man. So the second scenario, I'm thinking let's do a couple. So it'll be two people in the household.
2 people, okay.
And let's say both of them make about 80K a year. So
Each,
the
okay.
combined income will be 160K for that household.
Okay.
And then let's say on top of that they have a car payment of 350. And then I guess rent doesn't really matter because once they move out of their place, they're not going to be renting anymore, so that's not going to be a monthly cost. So really, we'll just use any debt. Let's say one of them has student loans also. What do you, maybe like $200 a month?
One of them or both of them? Give me a scenario, come on.
I think one
Okay,
of them
200?
was very studious and liked school a lot and decided to go for a master's degree.
So again, we're gonna work a little bit backward again. So first, I'm gonna take 160K divided by 12. Well, we can do it this way too. So we take 60,000. We also, since we do have some loans on the side, I'm gonna divide it by two different number. One is I'm gonna say like divided by 3, and you remember we go usually when people will take 1/3 for their payment.
Yeah. Let's say in this case they want to go up to like 40%. Can we do that?
I'm gonna give a range later, so have people to take a look at this, okay? And then I'm gonna take that 53,333, and then also divide it by 12. You are gonna get the same number, so 4,444. That is if you go for 1/3, okay? The reason why that I'm also gonna have a two set of number because we're also looking at the car payment and the school, and then like Weston, we're asking that like, hey, there might be a scenario where some bank might able to use like a higher debt to income, but usually what a lot of financial institute do is that they'll still take that 1/3, but since you do have other payment, they will take that 1/3 as your rent and your mortgage, but then anything between that 1/3 to 50% allow that threshold as your other miscellaneous loan, okay?
So you would get two loans?
No, so I'll tell you the range, okay? It will make sense as I'm doing this.
Okay.
Then I'm gonna put let's say your debt to income, we're not gonna, let's say we only up to 45%. Okay,
Okay.
45%. So back to 160,000 divided by
160K times 0.45.
so you get 72. Then we are gonna do all the fun stuff. We're gonna take that and divide it by 12.
So they can afford a total payment of 6,000 a month.
Now we're looking at the so before we get into that, we're looking at the range of 4,444, and also
Up to
also up
6,000.
to like 6,000, right? Now I'm still gonna keep this range for a purpose, okay? So now for the sake of it, we're gonna use that 1/3 for now, okay? With the same scenario that we had before, let's just say that we're going for that same rate right here, the 675. I'm sorry, 648.60. So I'll take the borrowing power will be 685,168 roughly over there. That would be the borrowing power. Now the way that how a lot of financial institute will look at it is that they will still able to remember we also use the scenario of there is two payment. The two payment that can be also excluded out of the first 1/3. A lot of financial institute will still see that as their payment power. Taking that 4,444 plus 350 plus 200. So the client obligation is still 4,994 because that 1/3, the first 444 is the property mortgage payment. So that could be still count as that 1/3, even though that person have other debts, other obligation.
Okay.
As long as they're not delinquent or anything, they can still use this whole amount
Oh,
for to borrow, and then this could be the anything between 444 to 6,000 a month. That could be medical. You have medical loans, you have student loans, you have car payment, boat payment, any other revolving and installment that can also be excluded out of the first 1/3.
okay.
Okay,
Okay. But
so
if it's above 1/3, then it's not excluded.
that what
Or is it?
no, so anything even though it is above those payment, even though it's above 1/3, it could be excluded, and the threshold can also be all the way up to 45%, and some places they can go up to 48%. I see. So something for people when people get nervous that oh shoot, I have a big loan or big installment or so, right? The financial institute can also look into that, and they can also like still exclude that as part of your mortgage loan on won't count that as part of your mortgage obligation.
Got it.
Yeah. However, the 4,444, if there is insurance, HOA, and property tax, that will be included
In the
in
four
that
four four four.
4,444, that 1/3. And some places, if you have a really high income, they won't use 1/3. They can even go higher. But for sure, I have not seen anyone that allow people to go on a regular conventional loan. They
Mhm.
won't. I have not seen anyone that go above 45%.
Oh, you haven't?
I have not.
I've seen some of my clients. I've seen some banks.
Unconventional loan, okay? Conventional loan, okay? If not convention loan, they are paying like higher on the interest.
Right.
Yeah.
Okay. Whenever it comes to that process, I always recommend comparing different options. Like you want to see one bank, maybe another bank will let you do a higher debt to income ratio, but then you have to compare the interest
Interest
rates.
rate, yeah.
Like, is the interest rate going to be a lot higher? And is that going to result in your payment being higher versus going with the other bank and doing a lower debt to income ratio?
Also, another thing that people will also look into is that I did see some loans where clients are paying like a high interest because of their financial situation. Some financial institute allow them to borrow more than the threshold. However, they're written a contract that they cannot pay back any loan earlier. If they were to pay back earlier, they still have to fork up the extra that the bank couldn't make off of it. So I
Oh,
did
like
see
a prepayment penalty.
payment penalty, and there's also some people call it a fee because like it really depends. And some banks do also have some kind of loan program where they don't really feel too comfortable still because maybe you have a bad financial and you're having a duplex apartment. They might require you to pay a higher interest and a balloon payment in 5 year or 10 year. And I do see that a lot too. So something for people to think about.
Oh yeah, balloon payments. In my opinion, you want to avoid those as much as possible. Definitely have some questions ready when you talk to your loan advisor. Prepayment penalties are another thing that he mentioned that aren't necessarily good because it will incur a fee even if you want to refinance a
Mhm.
lot of times.
It kind of push you to refinance because when it's about to expire, what those financial institute gonna do is that they'll tell you, hey, your balloons payment is almost up in 6 months or 1 year. Can you please update your financial? And then when you get the financial, they might ask you, they might continue for another 5 year or so, or or they will tell you, hey, can you do a refi? Something always changed. There's also a lot of unexpected. So that's something that people should be aware of. When they heard something like a balloon payment, they will calculate your loan as like a 30-year loan. Actually making the payment 5th year, 10 year. These are the ones I see mostly common. A year ahead, they will say, hey, you know what? Your loan is almost up. You might have to give a balloon payment. Here's your options.
So in what scenario would someone would it be beneficial to have a balloon payment, do you think?
For a house, I don't really see any benefit to be honest.
Yeah.
But usually, in my experience, usually people will do a refi every 3 to 5 years, unless you have a really simple life. You have a certain job, and you're gonna work kind of
Job
stop
stability,
stability
income
for the next
stability.
30 years because you're not gonna get that much raise. You want if you go with the 30 year, usually you're gonna fix that for 30 years.
Yeah.
But life is complicated, okay? Usually, like when I'm dealing with people, mortgage or loans or property, they will look into refi every about 3 to 5 years. For example, people want to upgrade their house, they want to buy in their house, they want to do a remodel of their house. Life changed. People get married, now people get divorced, kids go into college. They want to see if they can lower their payments so they have more cash flow into their wealth. So think about the balloon payment could be stressful, but realistically, is that a lot of people do make some kind of major changes every 3 to 5 years.
That's what you've been seeing every three
That's
to
my
five.
experience of seeing. I've been in this industry for over 14 years and do meet a lot of people. And I do have some people who are very been with me since then. And, in the beginning, purchased a couple, stayed humble, purchased a condo. After 5 years, hey, I had one kid. No, it's cool. They stay with, things got expensive. They still stay in the same condo, but they want to refi to stretch the loan a little bit longer, but at least their payment is a little bit lower. And because there's some tax advantages according to their CPA, so they did a refi to stretch their loan out. Then 3 years later, second baby comes in. Just one room studio is not going to cut it anymore. They want to get a house with 2 rooms, got rid of their condos, and then got in a single family home. As the kid's growing, kid is about like teenager now. They're thinking like, hey, college gonna come up. So what's gonna happen? So there's a couple options. Hey, they can think about. I'm only advising at the end. You choose what you want to do with your finance. So one of the suggestions is that doing a refi, stretch it out. You have more cash flow to save for their college, or if you see if you can shorten the loan and then see if the financial institute willing to give you even lower rate for shorter span of the loan, the financial institute might see that as a lesser risk. They might give them a lower rate. However, in the recent year, rates being gone up, so it doesn't really beneficial to them. But from what I know is that every 3 to 5 years, they will ask me to review their loan financials to see what makes sense to them.
Gotcha.
People might also
Okay.
consider consolidate their loans as well. Things happen in life,
Yeah, life is complicated. There's a lot of unforeseen things that can change things on a dime, so it's always good to be prepared.
Also, another thing about financial is that if you have a good rate, would you want to pay extra on the principal, or would you like to invest your money somewhere else? And it is
There's
opportunity
another.
cost. So that's why it's really, I advise a lot of people to work with a financial advisor or wealth planner so they can go over these numbers with you. So, you'll be more confident about your financial.
Got you. So what would it cost for someone, let's say someone like this, or actually the previous scenario, someone who makes 100,000 a year, how much would it cost for them to hire a financial advisor?
I would say shop with your local financial advisor, shop around. You can also PM me.
Yeah,
But I will say, like, when you pick a financial advisor, do pick someone with experience. Sad to say, not every financial advisor has the same experience. Even though they are trained professional, you want to see who can more related to you. How can they really help you in your long term? Picking a financial advisor is like picking the right doctors, picking the right lawyers, or hiring the right employees to work with you, or pick a great nannies to take care of your kid. It's no different, but make sure you pick someone that can help you.
is there like a range of how much it would cost? Is it usually
It really depends how complicated your financial is,
yeah,
and they're not too expensive.
okay.
That's all I can say. I will advise people to look, what can they do for you? That's more important. It's like if you pick someone that, with the low cost, but they're not giving you the right service, they never talk to you, then what's the point of hiring someone, right?
Yeah.
You want to give value, and you want to make sure you find someone that can take care of you, understand your needs, and someone to go to if you have any financial questions.
So do you offer an initial consultation for like people who just want to get an idea of what you could do for them and all that
Sure.
kind of stuff?
Message me and I'll talk to you. I'll go over what I like to do is that I like to go over people's financial first. That's more important.
Yeah.
Then we'll figure out, we'll take a look at the proposal. Or we'll look at more importantly, my process is first understand what your need and
Your
what's important to
goals.
you, your
Yeah.
goal. Okay. Then I will go over what I can do and what kind of service would you need. Then we'll go over how can we move forward.
Cool.
Mhm.
That's good news. Where were we with this scenario? So that person can afford up to 6,000 a month on a payment.
This person. So let's exclude the car payment in school, also other credit card. So this person with these couple right here,
Mhm.
with this payment, they could borrow 685,168.
And let's say they have 100K saved between them, so they could afford up to 785, but this is only principal and interest, right?
If that will equals to, let me just do some cross multiplying. Hold on. So this person exclude property tax, HOA, insurance. This person could start, doing this financial, assuming that 20% down, the house will be about 56,460. Assuming that the down payment of 20%, 171,292 is the 20% down, and that person is able to borrow 685,168.
Okay, got it. So
We're not calculating the HOA, if we're not calculating insurance, we're not also calculating the property tax.
so they would need 171,000 down to get.
With the loan of 685,168, assuming they have the 20% down, 171,292,
Mhm.
the house price will be, the buying power will be 856,460.
Okay.
Yeah. If they don't have that 171,292, if they have anything lower than that, that means that they have to look for the house that is lower, but they still have the buying power of 685,168.
Okay, so if they had just had 100K, then they could get a house for 785.
Yeah.
So with that in mind, I'm gonna see what's on the market right now under 780. So let's say this person lives in the East Bay. I think for that price point, Richmond might be an appropriate area they could move to. Let's see about this one. This is on Barrett. Ooh, that needs some work. As an agent being in this business for a while, I've met a lot of different buyers, but to be honest, most buyers fall into one category, and it's usually folks that want to move into what's called a move-in ready home where they don't have to do any work at all whatsoever. What a lot of people don't realize until maybe they meet someone who is in real estate and knows kind of like how deals happen and which deals go higher and vice versa. What a lot of people don't realize is the homes that are move-in ready are the homes that sell the highest and they sell the fastest, and they usually have the most competition.
Yes.
Obviously, everyone wants a house where they're not going to have to do a lot of work, and they just want to be able to move in, no stress, like you don't have to do any work, no renovations to manage, blah, 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 blah. If that's going to be your choice and you're going for a place that's move-in ready in a nice neighborhood, a nice location, you're probably going to be up against other offers.
Sure.
And it might be 2-3 offers. And so in that case, that's when the list price no longer becomes the sale price, because there's going to be competition pushing that price up, and you're going to have to work with your agent to try to analyze the comps and see and talk to the seller's side and see where your offer might need to come in to be a winning offer. But, you know, what I always recommend to my clients is, hey, why don't you buy a place that needs a little more work, put in some sweat equity, get your tool belt on, go to Home Depot, get all the tools you need, and, you know, maybe even do some of the demolition yourself and work with a handyman, update your kitchen. Maybe one year you just do your kitchen. Maybe the next year you do a bathroom. Maybe the third year you update the floors. You can make all these upgrades over time, and that's going to increase the value a lot over time. So I'm looking at this house in Richmond right now. This house definitely needs work. I can show you this photo. The siding, you know, the paint is peeling off. There could be water damage. Maybe some of the siding needs to be replaced. But this is the type of home where you're going to get a good deal, and you're probably going to get it below the comparable value of homes that are move-in ready. When you look at the photos of the inside, it's actually not that bad. It has hardwood floors, kind of like weathered a little bit, but you could just sand that and refinish it and it would look really nice. And a lot of people like the hardwood look. This property is listed at $649,000. It's been on the market 6 days, and it's a 3-bed, 2.5 bath, 1,944 square feet. So, I mean, for just the 2 people, that's a pretty big house.
That's pretty good, actually.
Definitely. Like, you could have a couple, you could have like 3-4 children and still be living large on the hog, you know? This one's on Barrett. It's pretty close to the freeway. Location's not too bad. And this does not come with an HOA fee because it's a detached home.
Sure.
So $649, let's say a home like this that needs work, maybe you're up against one other offer on offer day, and then it sells for $670. The taxes in Richmond are 1.11% of the sale value. If it sells for $670,000, $7,370 a year. So divide that by 12, that's $614.17 a month. Luckily, there's no HOA fee. Let's say this one is maybe in some kind of special hazard zone. Maybe it's in a liquefaction zone. In that case, you might need to get a special type of insurance. So let's say $1,500 is going to be the annual insurance.
Maybe flood insurance or
Yeah, maybe,
water.
yeah, like a flood insurance or something like that. So $1,500 divided by 12, that's going to be $125 a month.
How about this? Let's do a little bit of recap. You know, the process, since we did cover a lot of things. To recap, first, we'll think about what is your financial. You know, we'll look into your borrowing power. How much assets can you liquidate
Towards the purchase.
towards the purchase? Okay, so we figured that out. From here on, you go to the agent like Weston, and the Weston say, hey, you know what? With this estimate buying power, you can afford a house like this. From there on, he'll dig into what is the listing price, what is the potential that you might have to get a higher bid above the listing price, and also from there he can also get the estimate of property taxes and also insurance. Now we're back into how much can we borrow, or what is your purchasing power ability to purchase. Okay.
Yeah, how feasible is this purchase?
Yeah. So again, going with this house right here, you're thinking like 649. You think do we have to like overbid certain amount or?
Well, a lot of flippers are not really as active in this market as they were in like 2021. There might be one other party that's willing to offer on this, and maybe let's say their agent called the other agent, and then the other agent said, "Hey, we got another offer coming in." So they decided to go at 655, and then the other person was like, "Oh crap, they're bidding." So then they went a little bit higher. So let's say it landed at 670. And that might not be the case for this one. This one might just sit on the market. I mean,
so we can go a little bit backward. So with 670, this house, we're gonna take this 670. Let's just say that we are gonna put that 20% down payment. Beautiful world. times, we're gonna borrow only 536,000 right here.
And that makes the down payment
20%. So the down payment will be 134,000.
So no PMI needed at 20% down. 585.
Borrowing 5. What that translate into 536 30-year loan, and with the interest rate of 6.75, you're looking at your monthly payment of 3,449. With the previous financial, you have the ability to estimate your payment will be 4,444. We still haven't added the taxes and also the insurance, so we're gonna add that right now. So we'll take
1,500 for the insurance.
about 7,370.
Yeah,
that was the
actual number.
Yeah, divided by 12, 614, 17. So from here on, 3,000. So we got some number to work with. Okay, 3,476.49 plus 614.17. That is for the property tax. Okay,
614.17 per month.
Sure. Adding 125. That's the insurance divided by 12. So that will put you $4,215.66
per month total.
per month.
Wow. So that's actually, by today's standards, that's pretty low for a couple. I mean, you split that down the middle, that's like what? About a little over 2,100 per month per person.
$2,107.83.
So like if you're a single person in the East Bay and you're renting out just like a 1-bedroom or something, it could be right around that anyway. So if you want to go ahead and buy a house with your significant other, you'll be paying close to what you would be paying in rent if you lived alone. But now you own a property which you can fix up over time, building up your equity, and then each of your payments, a portion of that is going towards your principal, which also builds your equity in that property. And then, of course, you have appreciation. So like as the interest rates come down, usually the purchase prices go up, which means your equity or possible equity when you sell that property is going to be higher. And so this is how a lot of people build wealth over time.
Also, Weston, remember there's a scenario because like I mentioned that what if this person only have 100K? I believe adding 100K down, but that's all he has. So if that's the case, we'll take 100K.
So we'll do a scenario just if they
with the
only
same
had 100K.
financial, but he's like, hey, I don't have that extra 34,000. What can I do?
Yeah, they'd have to take a bigger loan, right?
Let's just say that if they could only put a conventional loan. So there's two scenarios. Since they still have a threshold to borrow a little bit more, up to showing the payment, they can make 4,444. They might have to borrow the extra 34,000. That will take them out of that 20% down. That means they had to pay PMI, the private mortgage insurance.
Okay.
That's one scenario. Okay. If they're like, you know what, I really don't. Personally, I will 34,000. I will consider it if I really want the house that bad. It's not too bad, to be honest. Okay. But if you were to go to this route, you might not get the loan of 7.5% because the bank might see that as a little bit higher risk. The interest may be a little bit higher, and you also have to pay PMI. Something to keep in mind first, okay? But in this case, and then this whole financial number might change a little bit. But let's just say the person's like, hey, you know what? There's no way I can do it. I only have 100K. Don't worry. So what we'll do is this. We'll take that 100K as a 20% down payment. If that 100K is only the 20% down payment, that means that person is able to 500K home.
Yeah.
Okay. And then also that means like if you put 100K down and 400K, and to get that conventional loan from here on, they can still borrow 400K easily because of the financial that we calculate earlier.
Yeah.
So that becomes, able to purchase a 500K home easily.
Let's say they bought a home or they want to buy a home for 500K.
So it's like two options. One option is that, hey, borrow the extra 34,000 and then, not to get the conventional loan and pay the PMI, or don't borrow the extra 34,000, get a property for 500K.
Got it. Okay. So you always have options, and obviously payment's going to be different if you're buying a property that's that much less in value, but most likely once you cross into the 500 kind of range, you're mostly going to be looking at condos because there's not that many single family homes in the Bay Area that are in the 500 to 600 range anymore. You'd have to look at the HOA fees and talk with your advisor and see what your payment would be.
Now, personally, I would have just borrowed the extra 34K and then go ahead and get a single family home, because a single family home, the appreciation value, the ROI, return of investment, is a lot better. One. Second is that if I were to pay that 4% when I'm out of it, I don't have to pay the PMI anymore. And also with this rate environment are so high, I'm hoping that like next year or so, the rate might go down. I could always refinance it if I'm paying like a little higher rate because of the risk. So personally, that's what I will do, knowing that, if this is my financial and this is a scenario for me.
So how much would the interest be on a loan of like 34K, you think?
It could be 0.1 to 0.25 more. So something for people to think about. But then at this moment, we're
Wait, so
talking.
what percentage would that be? Annual percentage?
We're looking at 6.75. If you were to borrow the extra
Oh, it'd be like
34K,
0.5% more than
yeah, it will be like maybe like instead of 6.75, maybe 6.85 to 7% estimate,
okay.
but also always negotiate with the loan officers to see what kind of rate can you get.
Got you.
Yeah.
So just real quick, maybe we can calculate that. Let's say, so it'd be
Yeah.
34, and then the percentage would be 685 per year. So that'd be 2,329 per year, right? Divide that by 12, that's an additional $194 a month. So you tack that on to the payment that we calculated.
You have to redo the whole thing because the first amount right here
Oh,
is
that was
yeah.
assuming a 20% down
Yeah,
payment.
yeah. So you have to redo the whole calculation. Yeah.
But it would be approximately $200 more per month, probably 250 per month.
But I will say that we will have to redo the financial
Yeah.
from that point too.
Okay.
But instead of calculate that 6.75, we'll calculate anywhere from 6.85 to 7%.
Gotcha. So it sounds like this couple didn't have that additional 34K. If they went and borrowed it from a bank at 6.85%, it's still, their payment still wouldn't be that bad for this home that we saw in
It's not
Richmond.
just a,
With their incomes, they both got 80K coming in. They'd still have a lot of money to, put some money into the home over time, fix it up, and then when rates come back down, maybe below 5%, that home might be worth 800,000, 900,000, maybe even $1 million, depending on how long they hold on to it and how many upgrades they make over time.
I'm gonna do a calculation real quick because I want to give people a little bit more accuracy if
Okay.
the rate does go up. Okay, so I'm gonna put the scenario as we were borrowing additional 34,000 because if we were to add that 34,000 when it not become the conventional loan, the whole borrowing cost gonna be more rather than just that 34,000. So I'm gonna do this really quickly. Okay.
Well, they would borrow the 34 to put towards their down payment, right? So they could hit the 20%.
Let's say if they do borrow that 34,000, they still paying the 100K, and then they're borrowing the extra 34,000 with the payment. How much would it be?
Okay.
When it comes to that, it's get a little bit tricky. Okay, some financial institute will add that together. Like they will take the whole thing as a one big loan. Some financial institute will separate them. They will separate that 536 as your conventional loan. That $34 will be a second loan.
Okay.
And then 536, that 536,000 will be the first tier of rate, means the lower cost, and then that 34,000 will be in a higher cost. But let's just say if you put the whole thing together, that's with a 6.8%, your payment will become $3,734.98 versus before was $3,476.49.
Got it. So it
Okay.
went up by
About like 250 per month. Okay. Every financial institute is different. Like I said, that some will calculate the whole thing as one interest, and some will separate the two different loans. And then people will try to pay off the higher interest rate first. That's what some people will do. They pay off the higher interest rate so that they can get out the PMI, also to get out the more expensive loan. So also another thing is that what is the best scenario? I can't say which is best scenario because everyone is unique. So therefore, that's why you want to talk to a financial planner to help you with this process. A lot of people might see a financial planner will only help you with investment, things like that. But a good financial plan will also look into your finance to help you make decision on should you pay off the loan, which loan should you pay off. These are the scenarios that they should able to help you with.
Sounds good. All right, sir. Well, thanks for
Yeah.
going over the numbers with us. These were two fairly common, I guess, scenarios in the Bay
Yeah.
Area, although in both cases they were below the median income. So maybe next time we can go into some of the higher brackets and
Sure.
take a look at what that looks like.
Yeah. Next time, maybe we can go over more of a higher net worth or clients, what are their financial is like. Or I can also share my previous experience. That's the scenario that I had before where people thought like they have a lot of money, but it's not what it turned out to be. Or some people feel like, oh, they're really hopeless. They couldn't get anything. They couldn't get anything, but it's turned out not as bad as people think it is. So I could share some of those scenarios.
Sounds good, man. All right, guys. I'll see you in the next one.